Ondas Holdings Inc., Nasdaq ticker ONDS, is currently trading at $6.55, marking an impressive plus 18.87% surge during regular trading hours today, Thursday, November 13, 2025. This stock is not just moving, it's exploding upwards on a volume spike, and the immediate trigger is the market's overwhelmingly positive reception to the company's Q3 2025 financial results announced just this morning. The expectation going into this earnings report was generally cautious, focusing heavily on the continuous high operating expenses and the constant need for capital raises that have plagued the narrative surrounding this small-cap technology player. Analysts were bracing for another significant loss per share, essentially a continuation of the high-burn growth story. But the reality delivered by the management has created a complete recalibration. They didn't just meet expectations, they shattered the low bar the market had set, fundamentally shifting the perception from a speculative growth investment to one with tangible, albeit nascent, execution. The core insight that demands immediate attention, the one that the market is just beginning to process, is not just the $10.1 million in record quarterly revenue, which itself is a six-fold year-over-year increase, but the absolutely aggressive and confidence-infused raised guidance for both 2025 and 2026. Management has increased the 2025 revenue target to at least $36 million, up from a previous $25 million, and critically established a preliminary 2026 revenue target of at least $110 million. That jump, a nearly triple-digit percentage increase in next year's forecast, is what is generating the massive upward momentum in ONDS stock today, pushing it well into the $6 range and challenging the recent technical resistance levels. This provides a compelling initial argument against the common belief that Ondas is perpetually a show-me story, struggling to monetize its technology. The sheer magnitude of the forecast hike suggests a significant, almost systemic change in their ability to translate contracts and acquisitions into top-line results, especially within the Ondas Autonomous Systems division. For a long time, the general belief about Ondas Holdings has been centered on a tension between two distinct, yet connected business segments. On one side, you have Ondas Networks, which is focused on the very specific, long-term deployment of a next-generation private wireless standard known as the .16 standard, primarily for Class I freight railroads in the United States. This segment is seen as having immense future potential, but its revenue generation has been slow, dependent on the massive, multi-year and often delayed capital programs of the railroads. On the other side is Ondas Autonomous Systems, OAS, the one that's getting all the attention right now, which is a rapidly expanding portfolio of autonomous drone systems, ground robotics, and counter-drone technology, largely focused on defense and security applications globally. The common market narrative was that the networks business was the stable, slow-burn investment play, while the OAS business was the volatile, high-growth, high-risk speculation. Today's report challenges that simplistic view. The reality is that the OAS segment is not just growing rapidly, it has become the undeniable engine of current revenue, driving nearly $10.0 million of the reported $10.1 million in Q3, representing an eight-fold year-over-year increase. This surge isn't organic in the pure sense, it's a calculated acceleration fueled by a spree of strategic, targeted acquisitions and capital deployment. The company has been particularly aggressive in Israel, with moves like the planned acquisition of Centrix, a leader in counter-UAS cyber technology, and the recent acquisition of Apiro Motion, an innovator in advanced unmanned ground vehicles. These additions are not just filling out a product catalog, they are strategically building a fully layered, multi-domain autonomy platform for defense customers, moving from single product sales to integrated system solutions. The recent capital raises, which had previously caused anxiety and concerns about dilution, particularly a $425 million offering in October, are now being viewed through a different lens, as fuel for an already executing growth engine, not simply as a lifeline for a struggling operation. The strong pro forma cash balance, which the company claims is now one of the strongest in the industry, provides the critical underpinning for the elevated investment thesis. The daily stock movement reflects this fundamental shift in perception. The volume accompanying this nearly 18% gain is enormous, indicating a significant rotation of capital and a strong buying interest, both from retail investors who might be trading on a platform like Robinhood or SoFi Invest, and more likely from institutional players whose conviction has been renewed by the guidance hike. The stock has broken through several short-term resistance levels, but it's important to remember the context of the price action. While the surge is impressive, the stock traded at a 52-week high of nearly $11.70. The current price is a significant distance from that peak, and the stock's history shows extreme volatility, swinging from a low of $0.57 over the past year. This is a characteristic of small-cap, high-growth names where the sentiment can change on a dime, especially around earnings. Traders on the Interactive Brokers trading platform are undoubtedly watching the order flow closely, trying to determine if the buying pressure can be sustained into tomorrow's session or if a quick profit-taking sell-off will materialize. The tension here lies in whether this is the true inflection point for the stock or just a short-lived earnings pop in a highly dilutive growth story. Looking at the institutional landscape provides some support for the sustained optimism. Recent filings, even those that predate this most recent earnings report, show notable institutional activity. Large institutional holders like Vanguard Group and BlackRock have been increasing their positions, a common pattern seen in dynamic, high-growth companies like Tesla stock and Nvidia stock during their early rapid expansion phases. This suggests that the deep-pocket players were already recognizing the potential of the OAS growth narrative and the strategic value of the acquisitions even before the phenomenal Q3 revenue was made public. This institutional backing, however, is being juxtaposed with net insider selling over the past 12 months, a detail that often gives individual self-investing and online investment participants pause. While insider selling can be for various personal reasons, the juxtaposition of institutional buying and insider selling creates a necessary skepticism that the most authoritative financial news sources or the more sophisticated analytical tools found on platforms like those offered by Fidelity Investments would highlight. To provide a deeper context for those new to the name or managing an intelligent portfolio, Ondas Network's long-term value remains tied to the North American freight rail industry's digital transformation. The company's FullMax technology, based on the global IEEE 802.16 standard, is intended to provide a secure, high-speed, and reliable wireless network for critical positive train control and various automation applications. This is a colossal infrastructure upgrade, and while the revenue flow has been slow, the sheer scale of the potential contracts, once the network deployments accelerate, is what keeps the long-term thesis alive. The OAS business, on the other hand, is firmly in the defense and security market, a sector currently experiencing a massive, globally driven uplift in spending for autonomous systems, counter-UAS capabilities, and robotics. This strong global demand is the clear tailwind for the raised guidance. The success of the Iron Drone Raider and Optimus system platforms, specifically in defense and security applications, including securing major defense customer orders and completing government-led counter-UAS pilot programs, provides concrete evidence that the investment thesis in OAS is grounded in real-world adoption. Now, let's look at the critical future outlook, always framing it with our expectation versus reality principle. The new expectation post-earnings is one of exponential, almost runaway growth, that the $110 million 2026 target is achievable, driven by a growing backlog and successful integration of the recent acquisitions. The reality check on this expectation involves three key areas: execution risk, capital management, and the networks business. First, execution risk is massive. Integrating multiple acquisitions, particularly in a complex, high-security industry like defense and with international partners, is notoriously difficult. Will the newly integrated entities from Centrix and Apiro Motion truly function as a seamless, high-output platform, or will integration issues create friction and slow down growth? Second, capital management. While they have a strong cash balance now, the high operating expenses are still present, and the company is still reporting net losses. A $7.5 million net loss in Q3, albeit an improvement from the prior year. The aggressive growth necessitates a constant need for capital, and any future dilution could still weigh on the stock price, especially for users of Robinhood stock trading, who are often highly sensitive to share count changes. Third, the network segment needs to show life. The company notes that network's revenue predictions remain conservative due to the slow pace of rail network deployments. For the stock to truly transcend its small-cap volatility and be viewed as a reliable growth story, the network segment must eventually deliver on its promised long-term value,